Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Worthington Enterprises, Inc. quarterly report. Worthington Enterprises, Inc. market capitalization of $3 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Worthington Enterprises, Inc. holds a significant advantage in their industry. Worthington Enterprises, Inc. trades at a higher price-to-earnings ratio of 256 times and a higher price-to-book ratio of 2.77 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Worthington Enterprises, Inc. offers a diverse range of products and services through its two main segments, consumer products and building products. The consumer products segment provides various tools and accessories for everyday use, including handheld torches, micro-torches, lighters, precision tools, drywall tools, propane-filled cylinders, helium-filled balloon kits, and gas grills. These products are sold under several brands, such as Balloon Time, Burnsomatic, Coleman, Garden Weasel, General, Halo, Hawkeye, Level5, MagTorch, Pactal International, and Worthington Pro Grade. The building products segment offers pressurized containment solutions, including refrigerant gas cylinders, liquefied petroleum gas cylinders, well water tanks, expansion tanks, fire suppression tanks, chemical tanks, foam and adhesive tanks, and sealing suspension systems. These products cater to various markets, including commercial, residential, automotive, and industrial. Overall, Worthington Enterprises, Inc. provides a wide range of products and services that cater to different needs and industries, making it a significant player in the industrial manufacturing sector. Worthington Enterprises, Inc.'s stock price has increased significantly over the past year due to several key events. The company's strong financial results have been a major contributor to this growth. In its second quarter fiscal 2026 report, Worthington Enterprises announced a 19% increase in net sales and a 7% rise in adjusted net earnings compared to the prior year. Additionally, the company reported an 8% growth in adjusted EBITDA and a 15% improvement in free cash flow. The acquisition of LSI Group, a manufacturer of commercial metal roof clips, accessories, and retrofit systems, for approximately $205 million, is another significant factor that has contributed to Worthington Enterprises' stock price increase. This strategic move is expected to enhance margins and broaden the company's engineered building systems footprint. Furthermore, the company's continued innovation in areas like data center cooling tanks has also been a major driver of its growth. The strong first quarter results, with net sales growing by 18% and net earnings increasing by 45%, have also played a significant role in Worthington Enterprises' stock price appreciation. The acquisition of Elgin and robust results from its building products segment have contributed to this positive performance. Overall, these factors demonstrate that Worthington Enterprises' strategic expansion and strong financial results have led to an appreciating stock price over the past year. The primary drivers of revenue growth or decline in a company's performance can be attributed to several key factors. On the positive side, strong overall supply levels and softer end-market demand in propane and propylene markets have contributed to revenue growth. Additionally, seasonal peaks in consumer products facilities matching consumer demand have also driven growth. Favorable product mix has offset lower volume in consumer products, while higher overall volume and the addition of Elgin in building products have further boosted revenue. On the other hand, revenue decline can be attributed to factors such as weak non-residential construction activity and pricing pressure, affecting Clark Dietrich's contributions. Furthermore, a decrease in revenue by 1.3% 3 months and 5.7% 6 months in consumer products has also contributed to the decline. In conclusion, understanding these primary drivers of revenue growth or decline is crucial for businesses to make informed decisions and adjust their strategies accordingly. By identifying areas of strength and weakness, companies can focus on optimizing their operations and improving their bottom line. Net income and profit margins. A changing landscape, the net income of a company has undergone significant fluctuations over the past year. Initially, it increased by $10 million from the prior year period to $25 million. However, this growth was short-lived as net income decreased by $5 million compared to the second quarter of fiscal 2026. On a more positive note, for the 6 months ended November 30, 2025, net income increased by $9.83 billion, 18.9%, compared to the same period in 2024. Despite these changes, profit margins have also undergone significant shifts. The gross profit margin decreased by 1.4 percentage points from the prior year quarter to 23.2%. Conversely, operating profit margin saw an increase of 0.8 percentage points to 12.3% during the same period. However, adjusted EBITDA margin declined, although the exact percentage is not specified. The reasons behind these changes are multifaceted. Net income was affected by various factors such as impairment charges, restructuring activities, and losses on marketable equity securities. Additionally, commodity contracts, foreign exchange contracts, and interest rate contracts also had an impact on net income. These fluctuations highlight the complexities of a company's financial performance and the need for careful analysis to understand the underlying causes of these changes. The company's financial performance indicates a positive trend in its operating cash flow. For the 3 months ended November 30, 2025, the net cash provided by operating activities was $51,518. This figure is even more impressive when considering the 6-month period, where the net cash provided by operating activities reached $92,580. These numbers demonstrate a consistent and significant generation of positive operating cash flow, suggesting that the company's operations are financially stable and generating sufficient funds to support its growth. The company's debt level has undergone some fluctuations over the past year. According to the extracted summaries, total liabilities increased by $33,395, and long-term debt carrying value rose by $15,720 from May to November. However, there is no significant change in debt level, as reported on page 19, indicating that borrowings under the credit facility remained unchanged. On the other hand, interest expenses have shown varying levels of change. While some pages report a decrease or stability in interest expenses, others indicate a significant increase. For instance, interest expenses for the 3 months ended were $1,472, 2025, compared to $1,033, 2024, representing a 42% increase. However, other periods show a slight decrease or no significant change. Overall, it appears that the company's debt level has increased, but with some inconsistencies in reporting. Interest expenses have also shown mixed results, with both increases and decreases reported across different periods. The performance of various segments within a company can be an indicator of its overall success. In this case, one segment stood out as performing exceptionally well. The consumer products segment recorded significant net earnings, with $27,328 in the 3 months ended November 30, 2025, and $62,476 in the 6 months ended on the same date. In contrast, there is no available information for the building products segment, making it difficult to assess its performance. This lack of data may indicate that the company has not released any financial updates or reports for this particular segment. Management is cautiously optimistic about the company's outlook, citing uncertainty in demand due to macroeconomic factors. However, they expect this trend to continue throughout fiscal 2026. To mitigate risks, the company will focus on creating value for shareholders through disciplined capital deployment and prioritizing operational efficiency. In terms of strategy, management aims to position the company for long-term success by optimizing operations and supply chain, developing innovative products, and pursuing strategic investments. This approach is expected to drive growth and create value for stakeholders. Financially, the company plans to fund its acquisition of LSI using cash on hand and modest borrowings. Additional capital may be sought through debt or equity issuances if needed. Management also prioritizes retiring or repurchasing outstanding debt when market conditions are favorable. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has purchased Elgin for $91.2 million on June 18, 2025, and Ragasco for $108.6 million on June 3, 2024. Additionally, a significant acquisition is expected to close in January 2026 with LSI. On the other hand, the company has also divested certain assets through divestitures. One notable example is the sale of its 49% interest in SES joint venture composite business for an undisclosed amount on October 16, 2025. These strategic moves demonstrate the company's efforts to expand and optimize its operations. The company's financial activities have been marked by a commitment to shareholder value. One key aspect of this is the payment of dividends, which has been a regular occurrence as indicated on pages 43 and 44 of the extracted summaries. This demonstrates the company's willingness to return profits to its shareholders in the form of dividend payments. In addition to paying dividends, the company has also engaged in share buybacks. As stated on pages 15 and 44, this practice allows the company to repurchase its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining investors. This strategy is often employed by companies looking to boost shareholder value through increased profitability and reduced dilution. There are currently no significant concerns regarding inventory buildup or supply chain disruption. This suggests that the current state of inventory management and supply chains is relatively stable. However, a potential issue has been identified on page 37, which highlights fluctuations in raw material prices as a possible threat to inventory levels and supply chain efficiency. This indicates that while there are no immediate concerns, there may be underlying factors that could impact the stability of inventory management and supply chains in the future. That concludes the financial summary for Worthington Enterprises, Inc. Feel free to comment below, and I will be happy to answer them when possible.